2011. It is 10 o'clock. We're at the New York City we're at the New York City Controller's Office, 1 Center Street, room 530, New York, New York. Now we do roll call of trustees. Ms. Ranji Nagaswamy.
Ms. Emery has Ms. Nagaswamy's proxy.
Mr. Larry Schloss.
Present.
Ms. Janice Emery.
Present.
Mr. Stephen Cassidy.
Mr. Straub has Mr. Cassidy's proxy.
Mr. James Levin.
Mr. Kelly has Mr. Slevin's proxy. Until he arrives.
Mr. Robert Straub.
Present.
Mr. John Kelly.
Present.
Mr. James McGowan.
Here.
Mr. John Dunn.
Present.
Mr. James Lamonda.
Here.
Mr. Sean O'Connor. Okay, Lee Tianam here. We'll have 24 votes and a quorum. We can start a meeting. We'll start with the public agenda. Larry?
Okay, we have Peter Fisher here from BlackRock to talk about what's going on in Europe. Seems like a good day to talk about what's going on in Europe since the markets are a mess. So why don't you bring in Peter and he can start us off.
Good morning. Please state your name and your affiliation to the record, please.
I'm Logan McKenzie, BlackRock, the Managing Director of BlackRock, responsible for all of the accounts in New York. And to my left is Peter Fisher, who is going to present to you this morning. We received a call asking us to come in and talk a little bit about what's going on in the world. You all read the newspapers. We are living in interesting times. A good deal of those times are in Europe. So Peter Fisher, Senior Managing Director and Head of BlackRock's Fixed Income Portfolio Management team globally, and is a member of BlackRock's Global Operating Committee from 2005 to 2007. Mr. Fisher was Chairman of BlackRock Asia, responsible for the firm's business in Japan, Korea, People's Republic of China, Hong Kong, Taiwan, Singapore, Southeast Asia. He was co-head of Fixed Income from 2007 to 2009. Prior to joining BlackRock in 2004, he served from 2001 to 2003 as Undersecretary of the Treasury for Domestic Finance, and in that capacity served as the Treasury's representative to Pension Benefit Guaranty Corporation, PBGC, and on the board of the Securities Investor Protection Corporation, SIPC. Before joining the Treasury, Mr. Fisher spent 15 years at the Federal Reserve Bank of New York, concluding his service there as Executive Vice President and Manager of the system's open market account for the Federal Open Market Committee. In that capacity, he was responsible for the conduct of domestic bond market operations, foreign currency operations, the management of foreign currency reserves of both the Federal Reserve and the Treasury. Mr. Fisher currently also serves as a non-executive director of the Financial Services Authority of the United Kingdom and as a member of the Strategic Advisory Committee at the Agence France Trésor. He earned a BA degree in history from Harvard College in 1980 and a JD degree from Harvard Law School in 1985. So Mr. Fisher, needless to say, is eminently qualified to talk to us about some of the things that are going on in the world today, and more importantly, its implications for the pension funds that we manage for you.
Your time's up. Yeah, it would have been shorter if you said I'm a recovering attorney and a bond geek. Would have been even more succinct.
For the record, Mr. Sean O'Connor stepped into the meeting.
Thank you. It's a pleasure to be here. I thought I'd try to put in context these extraordinary times we're in, focus on Europe. But before I turn to Europe, I thought I'd talk about the three major sources of uncertainty and volatility which make life difficult for all of us investors around the world, and then I'll put Europe in that context. And the fact that all three of these things are happening at once is what makes our lives so difficult. So thing one is the engines of global growth are changing. In the U.S., the engines of growth have been household consumption and housing. It's also been healthcare. Healthcare has been growing faster than the rate of the economy for some time. Housing, household consumption, healthcare is a form of housing, household consumption. All that has been powering our economy for 30 years, and that party's over. So we're familiar with that story. So we're looking around for a new engine of growth. What can drive this economy to above-trend growth? And we're not finding it in the usual suspects. We're not going to find it in household leverage, people borrowing up. So we're not going to be able to get consumption growing faster than income, right? So we're not finding it in business fixed investment. Businesses aren't feeling confident to build factories now. And we've been finding it a little bit in exports, but the rest of the world's now slowing down. More on in a moment. So here in the U.S., that engine of growth just isn't there, and we're looking around for another one. Asia and China has been a big engine of growth, and most of us can now see that's going to come to an end, at least the strength that they've had as an engine of growth. So in China, 46% of the economy is new investment. Now, think about that. So half the economy is building new railways, bridges, hospitals, factories, whatever, airports. Brand new ones every year. That's half of economic activity. All that has to happen for China's growth rate to be cut in half is for them to build the same number of hospitals and bridges and railways and airports as they did the year before, but not one more. Then their growth rate's cut in half. So this is the problem when you have this powerfully investment-led growth. We should be so lucky in the United States to have investment-led growth. At some point, they're going to slow down. You can't get above 50%. It's just too big a number. There are all sorts of fancy names. Economists call that problem the middle income problem, but you just can't keep investment growing that fast. So they're going to continue to do well, but they're going to have a soft landing. They're going to slow down. So that engine of growth. So we're all looking around for an engine of growth, and we're having a hard time finding one. If that's all we investors had to deal with, it would be we just go about our business of picking and choosing what we thought would be winners and losers. But two other things are going on that make us all feel much more schizophrenic. One is that the financial sector is shrinking. Our banking system got too big. And it's a very painful process to try to shrink a banking system. So it gets too big, you try to shrink it, that's called a banking crisis. And we've been going through that in the States and more on Europe in a moment. But when the banking system's too big and you start shrinking it, the pipes that create credit get smaller, and the people who are there to buy and sell stocks and bonds from you have a less balance sheet to do it. So the markets get more volatile and more uncertain. And the third thing that's going on, in part in response to the first two, is central banks are midway between changing regimes. For the last 30 years, they've all been targeting rates. They wake up in the morning and they try to figure out what's the right overnight rate. They try to manipulate the whole economy off of just changing one interest rate, the overnight rate. And now they're halfway to moving to quantity regimes, where instead of targeting a rate, they're trying to balloon their balance sheets and manage the size of their balance sheet is how they plan to steer the economy. And that's very upsetting for investors. We're all used to thinking of them manipulating this rate. Just opened the newspaper from 2 weeks ago. Chairman Bernanke went to great length to explain how his Operation Twist, where he was going to try to sell short-term bonds and buy long-term bonds, he said, I quote, is the equivalent of a 50 basis point cut in the Fed funds rate. And the whole time, the Fed funds rate stayed at 9 basis points. He's trying to describe a future regime he's moving to, where he's sort of manipulating quantities with reference to the old regime where he used to fiddle with interest rates. Now, this third one is upsetting to investors because we can't decide whether the central banks have all lost their minds and they're creating the next great inflation, or whether there are saviors who are bailing us out because the banking system's about to collapse, and thank goodness they're expanding their balance sheets so the bankers all don't have to shrink too quickly. So we go a little bipolar on whether we think the central banks are our heroes or the villains of the piece. And these three uncertainties, three sources of volatility are making it really hard for us all. and here we are. I think, as a 15-year card-carrying central banker, the central banks would, let me tell you, the central banks would not be behaving this way unless they were deeply worried about the financial system continuing to shrink too quickly and the risk of deflation. Now, they may be right or they may be wrong, but I want you to understand that's what's driving them. So the Fed is now ballooning its balance sheet. They're not doing a new program now, but just think of the last few years. They've pumped up their balance sheet because they're nervous that if the banking system shrinks too fast, it may trip up and start contracting credit in the non-financial space among companies. And the Bank of England's doing the same thing, and the Bank of Japan's been doing it for 15 years, and more in a moment on the European Central Bank, it's trying to decide whether it's going to do this or not. So I'm more worried over the next 3 to 5 years about deflation than inflation. You tell me that median income in Japan has been falling for 10 years. Median income in the UK has been stagnant for 5 years. And median incomes in the United States have been falling for 3 years now. It's really hard for me to get up in the morning and worry much about inflation if the people who have to buy the stuff have less income to do it with. But that's my view. You don't have to adopt my view. But it's worth thinking about. That's what's driving the central bankers. Now let me turn to Europe. With that backdrop, those are the uncertainties, and I think we try to invest well. You want to try to think clearly about each of those. What are the engines of growth? What do I think about the financial sector shrinking? What do I think about central bankers ballooning their balance sheets or not? Europe is in an acute mess. So let me come back to the way I was just describing it and talk about it in different terms. So 15 years ago, they committed to creating a single currency. They're going to take all the countries in Europe and get together and have one currency. There are 3 flaws that went into that in the way they thought about it. Most of the countries who wanted into the euro did it because what they wanted to do was not have to have a spread to Germany. They were sick of the Germans having the best economy in Europe. They were sick of the Deutschmark always being stronger than their currency. They were sick of people telling them, well, your currency is not as good as Germany's. And they wanted to get rid of it. And no matter how many times you told them, if you get rid of the currency, the spread's just going to show up in the bond market. They didn't want to hear about it. So they all thought they were going to get a world in which they could have different fiscal policies and the same bond yields as Germany. They thought, let's have a common currency and let's all group together, and then we won't have to have this differential with Germany, and we can all borrow and have our own national governments, and we'll have the same borrowing rates as Germany. Germany wanted into a currency union for a different reason. They were tired of having their neighbors competitively devalue away from them. So every time Germany would work hard to improve their competitiveness and how much they, making their factories more productive and they could make more Mercedes at a better price, all their neighbors would devalue their currencies. And they had a hard time growing. So Germany wanted to find a stable economy in which people couldn't devalue away from them. So it's a little like a marriage where each party goes in for the wrong reason. So they haven't lined up why they wanted to get married, and you're going to get a lot of disappointment. The third flaw was they thought they could have a common currency and not bother having one banking system. Right? They were going to keep their national champions. Big Italian banks were going to be different from big French banks. We're going to have the French banks just the way they always were. And so we're going to keep our own banking systems but have a common currency. Now, we tried this for the last 100 years, and over 100 years we figured out it didn't work. So when the Texas S&Ls went belly up in the United States, we didn't try to make Texas solve that problem all by itself. Because you take a weak banking system and you roll it up on a weak sovereign, it's just not going to work. So the third flaw was not thinking hard about one common banking system. So now we have the problem So you can look at Greece and say, gee, how can a little country like Greece bring down the mighty European economy? And the reason is that Greece is just an example of these flaws in the design of the euro. So it's one example, and the flaws exist throughout the structure. So the first flaw is that everyone expects to get the same bond yield as Germany, but having their own fiscal policy. And now we see it doesn't really work. You can't borrow all the money you did if you were Italy or Greece and then get the same bond yields as the Germans. So that expectation is disappointed. Yes, you can lock yourself into an exchange rate, and now Greece and Portugal and Ireland and Italy can't competitively devalue away from Germany by lowering their exchange rate. But how are we going to get competitiveness into the Italian or the Greek economy? And here we are, and no one's got a strategy for how you're going to get those economies growing more quickly. The Italian economy's been stagnant for the last several years, no growth, just straight line, nothing. And Greece is contracting. And finally, the banking system, the crisis, really, the transmission mechanism of the crisis is through the banking system. We talk about contagion from one country to another. It's not a germ. It's not, going down the telegraph wires or the highways. It takes place across bank balance sheets. So the banking system in Europe's too big, back to the problem of a shrinking banking system. The first thing they did, they were too big, too many banks, too many deposits, not enough opportunity to create credit. So what did they do? They bought a lot of mortgages from America in 05, 06, 07. And the reason we know that's what happened is the first sign of the crisis in the summer of August of 2007 was extraordinary pressure in the foreign currency swap market. As funding for the European banks, their dollar liabilities, their dollar assets dried up, and they rushed to try to finance themselves in the currency markets, and it disappeared on them. So that didn't work. They had too many deposits, not enough assets. They got too big. Here we are. And now the way they tried to dig themselves out of this hole was by buying an asset that the bank regulators say gets a zero risk weight and levering it up. Sovereign bonds. So they put on the trade inside all the banks that John Corzine's being criticized for putting on inside of MF Bond you read about in the papers, MF Global. Right? Buy a lot of debt you think is going to be money good, lever it up, and then it turns the mark-to-markets run against you when the market's under stress. And now the only way they can shrink a bank quickly is to sell your most liquid assets. What are those? Those are the sovereign bonds again. So here we are, and we can watch the Italian bond yields backing up as the holders of them that are weak hands are forced to sell. Now, it's all been pretty gloomy. There are three policy levers they have to pull in Europe to try to work their way out of this. It's a mess. There's monetary policy, there's fiscal policy, and there's bank regulatory policy. How much capital. And it's tough to shrink a banking system, as we discovered in 08 and 09. It's not a pretty picture. But right now, what the Europeans have been pursuing is tight monetary policy, tight fiscal policy, and tight bank regulatory policy. And it's a competition in orthodoxy. Everyone's going to try to be more Catholic than the Pope, if you'll forgive me. And they're all going to try to outcompete each other by how virtuous they can be. And they're in the process of grinding their economies to a halt, while the politicians argue about how to carve up the bill for the mistaken way they designed the system. So push comes to shove, on the first day in office, Mario Draghi, the president of the European Central Bank, has to lower rates. Because policy, something's got to give. They got to start lightening up on policy. And they can't shrink the banking system too quickly. And if each country tries to shrink what the government's doing, government spending, too quickly, they got to be careful. You can't just write open checkbooks. So there's a difficult dance here for Mario Draghi at the ECB. If he just opens the spigots for blowing up his balance sheet, and Italy and Greece keep borrowing too much money, that's not going to end happily. So there's a delicate path to weave here, but it's going to involve them lightening up on policy somewhere. And you can see monetary policy is the first to give. And so I think we see extraordinary movements in markets now. Yes, everything is manic in markets, this risk-on, risk-off behavior. That's why I partly talk about we're all a little on again, off again about the financial sector shrinking. Is it going to come to an end, or is it going to be stabilized? Are the central banks lunatics, or are they saviors? We all get a little bipolar in the capital markets. And we try to look through that and find value. And yes, a couple of weeks ago, well, no, it was just Sunday, forgive me. It seems like longer ago than that, but we had that 10 days ago. We had the chance to look through the MF Global portfolio, and we came to the conclusion, you know, these Italian bonds might look even more attractive in 10 or 15 days' time. And they have. So our bond managers are starting to think, you know, Italy probably is going to survive. But the shrinkage of the financial sector gives this incredible volatility to markets that makes it really hard to price, to decide where you want to jump in, and at what point do you want to buy Italian debt. We try to be prudent about that. I don't think the Italian government's going to go bankrupt, but it's a very tricky path they have to follow in Europe. Let me stop there. I've touched on a lot of themes. I know that's a mouthful. I've tried to say as much as I can in plain English. Let me see if you have any questions. I'm happy to pick up any theme you'd like.
When do you get to the good news?
I'm a bond guy, I told you. I think that you asked me to talk about Europe, and it's hard to find good news in Europe. So I can give you a better story about the U.S. or the world than I can about Europe.
On the way in this morning on the radio, I heard the Dow futures are down 247 points already. So that doesn't bode for a very good day today.
Yeah, I think that's part of this manic, you know, we're on, we're off. I think that Europe is going to have to find a path to the ECB expanding its balance sheet and the government stop this competition in virtue, fiscal virtue. It's just if everyone is saving money, there's not a lot of income left for everybody else in the short run.
Do you think that the euro is going to stay intact? Or what happens if the euro, if companies pull out the euro?
Well, if countries, if a little country like Greece falls out of the euro and they give us enough confidence they can hold the rest together, it's kind of a political confidence issue, I think that's manageable. Italy is the 7th largest bond market in the world. So you try to take that out of the euro, it's a little, that's hard to imagine they can pull that off and it not be real calamity for the banking system. One way to think about this is the Germans really want Greece to stay in the Eurozone. And they don't want to underwrite the Greeks' profligacy. You can kind of understand how they feel about that. The thing that Germans haven't quite been able to sort of wrap their mind around, if you want the Greeks to stay in the euro, you have to give them some kind of banking system. They got to have some way to pay each other and save money, and you just can't shut down the Greek banks and expect the Greek people to take a 40% haircut on their standard of living, and everything's going to be happily ever after. So Europe is tough. A number of months ago, I was discussing this. I'm on this advisory committee to the French government to manage their debt, and we were discussing this. And a man who's known me for 20 years said, "Oh, Peter, you're just one of those Americans who doesn't believe in the euro." One of the other senior advisors to the French government. And I said, "No, you misunderstand me. Everything I just said is I think you're going to save the euro. But the way you're going to do it, you're going to give up a decade of growth in Europe." And his response was, "Oh, I'm very sorry I misunderstood you. You're absolutely right." Now, the trouble for us will be if they get their act together, then the spotlight will go back to Washington and we'll see if we can get our act together down there. So we've got our own problems, but I'd much rather have ours than theirs. The economy grew 1% in the first half of this year. It's going to grow 2.5% in the second half. Unfortunately, we'll probably slow down a little bit next year again. So we're in this sort of bumping along at 1.5% to 2% growth, which doesn't feel very good. But as long as we're gradually shrinking our banking system, we're gradually helping households get over too much borrowing to push up the housing bubble. As long as we're doing that relatively gradually, that's actually better than where you end up with in Europe. I think it's entirely possible the super committee can do the right thing. Whether they will or not is another matter. They really should not try to cut spending over the next 2 years. The economy is way too fragile for that. But if they could just figure out how to spend $500 billion more for 2 years and then cut $3.5 trillion out of years 3 through 10 for a net $3 trillion off our future liabilities, the markets would love that. Our economy would do much better. There'd be a boost of confidence. We would have much lower risk of recession in the next year or two. There's a reality test we have to come to. One of the most frequent questions I get is, are we going to have a double-dip recession? And I say, well, let's be clear. We're going to have another recession in my lifetime. We're talking about when, not if. And for most of my life, or let's say the first half of my life, we had recessions every 2 or 3 years. That's the 1950s, 60s, and 70s. No, the last 25 years, we managed to get by only having recessions every 7 or 8 years. So it's going to be somewhere in between. We're going to have a recession every 3 or 4 years going forward. And so it's in our future, and that's not the end of the world. We'll move on. The problem is the Fed's doing almost everything it can, and Congress is now wrong-footing us. And cutting spending too quickly would be dumb, and not cutting spending at all, given the rate of borrowing we have going, would also be a mistake, I think. So it's about the time path, and they can figure that out. They get plenty of smart people advising them. They've just got to figure out how to vote that one through. And I'm much more optimistic about the U.S. than I am about Europe. So you asked for some good news.
So Peter, when you have this car crash in slow motion in Europe, 6 more months till these guys get to some bottom and do something that you can look at and say, aha, when do we get an aha moment that you can kind of get past?
Well, there are a couple of booby traps they've laid for themselves they've got to get past. And maybe they can get past them. So they've set up the exchange, their European Stabilization Fund. And it only really works if the countries in it still have a AAA rating. But if you're France and people are wondering whether your banks are money good, you want to stand behind your banks, and you want to say our banks are, that's what we did in the U.S. in 08, 09. So, but then they take a downgrade, and then the fund doesn't work anymore. So that's not a big deal. It's just one of these little landmines they've set for themselves. They got to figure out a way to get past that. I think the aha moment is either they're in it together and they're going to have the political will to both get some growth going. I mean, it really is hard to see how they get their way out of this if they follow this bleak, no growth. Because then the banking system just has to shrink all the faster. The sovereigns don't have any revenues so their fiscal outlook looks worse and worse. So the aha moment, I think, has to come there. The aha moment that we're worried about is, that it looks like Italy, can't make it or something, and that just seems silly. Deep down, another mistake they've made, so they got to get past this, is they've tried to instill our confidence in Greek bonds by saying the Stability Fund is going to be a guarantor of the bonds. The taxing power of the Italian government is much more creditworthy, in my view, than this Stability Fund, which is 14 PhDs in Brussels. There's not a dime inside the thing. It's a bunch of IOUs from a few countries, and it's not the collective full faith and credit of Europe. It's maybe kind of, sort of. We'll see tomorrow whether it's the full faith and credit of collective Europe. So wrapping a credit with a worse credit doesn't get you anywhere. So the aha moment is going to have to be to cut through some of that underbrush. Now, I think that and stand behind their banks. And one of a good piece of news, aha moment that's coming, is the bankers are getting sick of this, and they're writing down their peripheral debt and saying, I'm clean, and they're proving it to their investors. That's a very important moment. If we get 4 or 5 more big European banks, BNP did a pretty good job of that this week. And that's something that happened to us in the 1980s. Remember our S&L crisis in the late 80s? Frankly, the Fed was trying to keep the banks from marking down their Mexican debt from the 82 Mexican default. And we didn't, because of the pressure it would put on the weak banks. And J.P. Morgan said, forget about it, I'm marking mine down, I'm done. And Paul Volcker was furious at them. But it was the healing moment. It was, you get past it. Now we're going to separate the sheep from the goats in the banking sector. And that, I think, is one of the most important aha moments. And if enough of the big banks actually can persuade investors they've not just marked it down, they've marked it down, they pushed it through their income statement, whatever losses they're taking, they've taken, and they're done. That's a big part of confidence that they need to not have Italian spreads keep backing up.
And the capital for the banks, the federal bank, or the governments themselves?
Well, the governments can backstop their funding. I mean, this is... my Uncle Leonard taught me about the man who'd learned from his mistakes, and now he can repeat them exactly. So the Europeans repeated our mistake exactly, which was to, in public, threaten to make the banks raise capital. So that's what Bernanke did in March of 08, and Bear Stearns died 10 days later. When you do that, you tell all the equity holders dilution is coming, and they all sell. So it's something the authorities on both sides of the Atlantic have gotten wrong this crisis, which we didn't get wrong in the late 80s and early 2000s, early 90s. So it's analytically the right thing to say they need to have more capital. To argue about it in the middle of the street destroys investor confidence. You have to move on. But marking their assets down and being done with it and persuading us on that front then gets us past the issue of whether they need more capital or less or where it's going to come from. And I think that's the pivotal step. We're all a little too clever in financial markets. So, real story, over the last year, big European pension fund looks at its exposure in peripheral European debt and says to itself, this stuff is too volatile. It's not why I own government bonds. I don't know whether they're going to default. I don't, just get rid of them, would you? It's too volatile. Doesn't work against my benchmark. So, the asset manager sells them. The market backs up. Everyone says, probability of default of Portugal just went up. Because that's what we measure. But all that happened was the big pension fund said, too volatile. Not for me. Find me another flavor. So we need that process to stop, of the unstrong hand, the weak hands letting go. And it's real. And so those will be a couple of the important aha moments. Oh yes, certainly months. Well, months to get through some of these speed bumps, I'll call them. We get over them, and then the ride gets less bumpy. But it's going to a year or so to see whether Europe can get on a growth path.
But given the question about where are the engines of growth, both the delevering that's going to go on for so long, do you have any longer-term timeline on, one, when the big deleveraging ends, and two, when growth occurs, can it anywhere near approach historical levels, at least in the developed countries?
Yeah. Ken Rugoff and Carmen Reinhardt's book, It's Different This Time. It's a tough read for some of us. 800 years of history of financial crises. And it's a really simple conclusion they come to across hundreds of years. It takes about 10 years. You get a big financial crisis, whatever the size of the economy, the financial sector gets too big and it really is the best science you have of looking at all the lessons of history, is the better rule of thumb is 10 years to get over the delevering, whether it's Japan in the 90s, which then there are other problems that come up, or Sweden, their demographic profile then adds to it. But Sweden in the 90s, whatever episode you want to look at, the better rule of thumb is 10 years. And I think that that's one of the hardest things in financial markets. Investors want to know, is it over yet? Are we done yet? And no, it's going to take longer. Now, we've got a lot of savings in this country. I don't quite like the idea of a savings glut, but households' savings rates gone from 2 to 6%. Corporations have $2 trillion of cash on their balance sheets. There's a lot of savings around. There's not a lot of confidence to invest it at present. So the most hopeful thing that can happen over the next 10 years is for China and us to reverse roles. They've had investment-led growth, and they're going to run out of gas on that. And we've had consumption-led growth, and we've run out of gas on that. And now we can shift places, and we can have investment-led growth here, and they can have consumption-led growth there. And that seems to me the likely outcome over the next 10 years, somewhere in here, given the amount of capital we've got. I forget the exact number right now, so forgive me, but you look in the Federal Reserve's flow of funds data, and you try to find out household net wealth in the United States. So I'm afraid for the record I might be off a little bit. So everyone likes to say Americans are living beyond their means. We got something like $45 trillion of household net wealth in the United States. Now, where it is and what our expectations were and how there's we expected it to grow at a certain rate, and it may not grow at that rate. And we're going to be disappointed. But the way to fix it is to get to investment-led growth, and I think eventually we will, because we've got the savings pool lying around. But you got to get past the confidence issue with people to make the investment decisions. That's very optimistic of me. I surprised myself. Other questions?
If there's no question, thank you for your presentation.
Sure. My name.
You'll remind us when it's time.
Yeah. I'll give you a ring.
Yeah, we forget.
Let the record reflect that Mr. James Levin joined us during the presentation.
Yeah. I'd say that was uplifting, but it wasn't. So it's a good way to start the day. Let's go to the September monthly. And we'll skip the economic section. So let's see if we can start on let's start on page 21. So picking up where Peter left off, this is the VIX, right? So this is volatility. Markets have been very volatile since August, when we had the debt ceiling discussions in the United States and the downgrade, and then focus moved over to Europe. So we have our problems in the U.S., as he was talking about, as well as in Europe. The next page is the yield curve. The white line is the current yield curve. You can see the Fed's been very good at dropping the short end, and now with Operation Twist, they're going to be working on, this is the big numbers in the middle. So they're working on getting it down again, the sort of pumpkin-y seasonal color from the end of last year to now. You can see that the curve has shifted very well down, but again, they want to keep working the longer end down, 7 to 10 years, so that people will try to refinance their mortgages and try to get the housing market started again, because it's completely stalled out. If you look on page 23, again, this is a really treacherous market because of what happened in Greece with the change of government I guess it was the beginning of this week, and Berlusconi is saying he's going to leave, so 2 governments have fallen in the last week or so. This 10-year rate now is again below 2%. So it looked like things were getting calm, and now it's not calm anymore. Today the market's down 300 points. So we're back into the volatility vortex. On page 24, that manifests itself, besides the government rate going down, with spreads widening. So you can see the high yield spreads have blown out again to 700 plus. Recall that when it was tight, we sold some high yield bonds. We'll come back to what we're doing now, but the selling was good. But again, risk is, you're getting back to risk off. The next page, page 25, you can see the earnings, which is the blue line, of the S&P 500 been going up, because again, corporations have cut expenses, which is terminating people, which is why unemployment is so high, have a lot of cash, the earnings are going up, the stocks aren't going anywhere, so your multiple goes down. So the S&P 500 multiple is now below 14, which is pretty reasonably priced. You can see on the next page, page 26, the blue line, which is the second line for those that have it in black and white. Again, corporate profits doing very, very well. So it's not corporate America that's the problem. It's elsewhere. Page 27, these are the multiples trailing and projected for the Russell 3000, EFA, and emerging markets. And again, the equity markets are looking reasonably inexpensive, but there's a complete lack of confidence in the future. You go forward on page 28, the same thing, reasonable valuations for large, medium, and small cap. Page 29, again, the relevant, you can see sort of, you go back to sort of August, where it says 29, you see this sort of up and down, and the white line is the U.S., which is the top line, again, if you have black and white. And then people basically thought the coast was all clear recently, and obviously the coast isn't clear, so it's going to go right back down. And that the EFA markets went down further than the U.S. markets, and emerging markets went down further than the EFA markets. If I can get you to page, I want little numbers again, page 31 in the upper right-hand corner, the value of fire. This is the 10-year rate. Probably go to the next page, which is 32. And I'd also have you jump to page 37. 37 in the upper right-hand corner. So we're looking at September numbers. September is one of those down legs. So if you look at the indices on page 37, the top block is the U.S. stock market. It was down 8 to 10 to 11%. The international markets were down 10 to 15%. And the bond market, the high yield market, was down 2 or 3%. So it was a lousy month. The good news is it completely reversed in October. So if I go back to page 32, what does it mean for fire? So fire went down in September to about 7.2. At the end of October, which is the up month, we're back to about 7.7 billion. So in our portfolio, 7.7. So I don't want you to get depressed about September, because the next month we're going to come back and everything will be good again. But we are going to get into an up and down period until things stabilize. And again, Peter couldn't tell us when that's going to be. He'll call us when we get to the aha moment, and we'll wait by the phone. So then you get to page 33, which is our asset allocation, and recall that we're going from 33 to 34, which is the old asset allocation, the new asset allocation. We're going to talk about ranges. The number that jumps off the page on 33 is cash, which is 9.9%, which is unrealistically high. It's partly unrealistically high because the denominator went down, that being the total value of the pension fund went from sort of 7.9 down 10%. So it's really closer to 8, let's call it. And since September, we've been putting money back in, partly because we're trying to get a little bit of, take some opportunistic investments on the one hand. On the other hand, we're trying to get to this new asset allocation in very, very choppy markets. So I would tell you that the 9.9 is really 9.2, let's call it, if you have a bigger denominator. And since September, we've put about 1% back into high yield. We put about 0.5% into REITs and about 0.5% into emerging markets equities. So really, we're about 7%. We're not going to take it back up. We're kind of okay with about 7% where we are. Again, we're trying to get slowly, because the markets are choppy, and it'll take us, I don't know, the better part of a year to get from page 33 to page 34. If you look at page 34, so again, keep in your mind that we're really around 7% cash. Things that are in the hopper are, if you look at the third bar from the right, which is opportunistic fixed income, recall that we've approved a series of managers, and we're going to see another one today on opportunistic fixed income. We've probably approved 3%. The managers don't have the money yet. We're working on documents, but 3% of this portfolio that's now in cash is going to be moving to opportunistic fixed income. So again, if you think about the cash, you're going to go from 7 to 4 pretty quickly once we get these documents and these managers take advantage of these markets. So that's already in process. And now we're below 5. And the rest is partly market determined. Again, trying to move the asset allocation, which is going to take us a better part of a year. So I'm not very concerned about where the cash was. And given all the volatility, I think we've actually done a pretty good job of avoiding it, because if you think about the $7.7 billion that we have today, it's probably down 3% or so from the beginning of the fiscal year, which, given all the bouncing around, not too shabby, I would tell you. So that's a lot of moving parts, but it's, again, we picked the time to redo our asset allocation. I guess it was in June we approved it, and then the wheels started to come off the markets. So we're working it. You can see, again, coming back on page 34, we're about right in the U.S. equities. And we're going to talk about where these ranges should be. But again, I wouldn't worry about the U.S. equities where we are. Opportunistic fixed income is all right. The hedge funds, as you know, we approved our fund, we invested our fund to funds. Seema will talk about that in a minute. And we're going to start picking our individual investments over the next 18 months, let's say. Slowly but surely, and again, Seema will talk a little bit about that. That gets us to page 36, which is how do we do in September. And again, we're down 5% in the month of September. We probably made at least 5% in the month of October, so I wouldn't get too hung up on that. Similarly, the fiscal year to date, which is through the first quarter, down about 10, and we're probably, as I said, we're probably down 4 or 3 when you add in October, so bouncing around. And you can see how we did last fiscal year, very good, and as well the fiscal year before. So stay tuned. It's, again, if you look at what's bouncing around, it's the equity markets that are driving the returns up and down, offset a little bit by fixed income, but it's just very, very volatile. With that, I would ask Seema if you have something you want to talk about in equities. A comment or two? No? Martin?
We have a comment about a specific manager and investments that we'll talk about with that.
Okay. Barrett? Yvonne? No. Okay. So again, there's an awful lot of reds and greens bouncing around on the individual managers. I wouldn't get too caught up on it because the next, they're choppy, so people can easily underperform the index, but the bigger numbers as opposed to the variability, this is a bad month. September was bad, made up for in October. TBD where we end up. So, difficult time to be in the very short term managing this, but longer term perspective is good. I think we got that pretty well set up. So if anyone has any questions on September, we can get to the discussion on ranges. Want to talk about? I'll let you lead that.
Sure. Good morning. If you turn to your book, we've actually prepared ranges for your review. What we done is, of course, a discussion piece for feedback from everybody. But what we have included is we want to make sure our discussion last month to ensure that it was very reflective of what the investment policy statement says presently. And what I mean by that is that it's set up from an organizational standpoint and that we have sort of larger buckets as it relates to to public equity, fixed income, and then cash ranges, in addition to some of the smaller sub-allocation or sub-asset class ranges as well.
This is page 60 in the book.
Yes, page 60 in the book. So what we've shown you is what the old long-term strategic allocation is. The new long-term strategic allocation that's already been approved. The other piece that was brought up last month was having an interim allocation. Again, we are in the process of moving the portfolio from old to new. And so that was one of the requests and the feedback that we got previously, that there was an interest in making sure that we had an interim allocation, and that is listed. What was taken into consideration when we put that together had to do with how we were moving the assets. So there are some areas that are a little bit different than what the long term is. We do anticipate over time that they will move to the long term. So this is just what it is called as interim. It's not permanent. And so one of the things that I know we'll probably discuss is cash as an example. We have it at 3%. That is really reflective of the fact that there are some other asset classes such as hedge funds and opportunistic fixed income that are going to be sourced from cash. And so from that perspective, we could have done 0, and we're open to feedback on that, but at this point we thought that 2 to 3% was more realistic, because we are holding some assets there that will be ultimately moved. Again, once we move towards the target, long-term target allocation. We also showed the proposed target ranges and the current target ranges. There are some differences between the proposed and the current. Some of those are reflective more of what our viewpoint is on how the markets are reacting, as well as the implementation process that we are going through. And so maybe I'll stop there, unless you want me to go through each and every number and ask if there's any feedback. And I'm happy to go through each and every number. I want to kind of get some guidance from the board as to how we might want to move the discussion.
I would just pick up the highlights. How about that?
Sure.
You got some highlights you want people to look at?
Sure. So for the total equity, we obviously the long term was 70%. The new is 65.5%. The current is 66.45, because again we're going to be moving. The interim. We're going to be moving assets around, so it's a little bit higher. And we've moved the proposed target ranges because we are including things like hedge funds and the like into this. And there's some increases in some of the sub-asset classes. So we've increased that proposed target range by 1%. So that's plus or minus 6% versus what it was previously. Let's see, which was plus or minus 5%. For the fixed income, your old target range was 30%, and we have moved that new, which was approved into the long term, to 34.5. That's your new target range. The interim is around 30.5, and the actual proposed target ranges are the same, plus or minus 5%, both from the current and as well as from the past. And so that remains consistent again with our viewpoint on where we think it should be. And then I talked a little bit about cash. We do have a 0 long-term target for cash, 3% and as an interim, and for the reasons that I mentioned before, we felt that it was potentially optimal to have a 3% target, because we are going to be sourcing over the longer term, and it could be 12 to 18 months into some of these other asset classes. But we still keep a target range of 0 to 5%, because again, there's going to be some variability. We just heard Larry talk about the fact that we're even higher, significantly higher than that right now. And so it does take some time to work through that piece of it. So those are the highlights. Again, the sub-asset classes are there as well. So I'd like to know if there's any additional feedback.
So I've had the benefit of seeing the proposed target ranges for some of the other boards on which I sit. And this is actually the first time I've ever seen a proposed target range that was asymmetrical. So typically they're plus or minus the same points. We're thinking about this collectively, and BAM is thinking about this as well. Could you explain to us the reason that you're introducing an asymmetrical range?
Sure, there are a couple of reasons. One, as we talked a little bit about implementation, that piece is embedded, and I know we do differ for some of the other consultants. And also, we've also taken into consideration risk and volatility and where our opinion is from that perspective. And so that is an opinion that's somewhat subjective. There are people who do just do plus or minus, and that is also an appropriate methodology to utilize. But from our perspective, we want to look at it from a risk standpoint as it relates to where do we feel that we start to get, or it's our perspective that we start to get uncomfortable on the high end or the low end of the asset class goes to those points. And when you look at it from that perspective, it may or may not always be an equal amount. And so we didn't want to constrain it. With that being said, we are happy to take feedback about that. But that combined with the fact that we are moving into some asset classes. So as an example, let's look at hedge funds. Right now, we're in the process of moving into hedge funds. And so you have, 0 to 1% level at this point in time. And so it makes sense to have it broad enough to be able to capture that, so that you don't immediately move out of policy, because that's the other challenge. And again, that would be the pleasure of the board as relates to your comfortability with being out of policy for a short period of time. So you either have to have the ranges large enough, or you have to change that interim policy quite frequently to be able to capture that. And so that's a tomato type of decision as to where the board would feel most comfortable.
Yeah, I guess it gets to the question of whether you want to have interim ranges around interim targets, or just understand that you're going to adjust the ranges as you move closer to implementing your long-term policy. And then I think that's when you see that it is more symmetrical in the ranges that we propose. I mean, all the ones that are asymmetrical are essentially the new categories where we're going to be funding them, anticipate funding them over the next 12 to 18 months.
Okay. So I guess that was my misunderstanding. Thanks for clarifying, because we do need two things. We need to have a long-term policy. That's our target, and our long-term ranges around that. And then we do need to have an interim policy. So I think we should think about it both ways. You're right. So our long-term policy ranges should be symmetrical, but perhaps our interim should be asymmetrical.
I mean, part of the biggest goal of this is to have a framework that we can adhere to, both in the short term and the long term, and that's what we try to accomplish. I mean, I haven't seen the data from the other funds, but I'd be happy to kind of comment. I know we had some differences in where we were recommending allocating capital that was uninvested in some categories that are liquid. And so I'm happy to talk about that. And there's as much art to it as science. So
I think that we would benefit greatly as a board if there was a coordination between you and BAM and talking about what the best thinking is of all of our consultants. I think we would all benefit from that. So perhaps.
We're going to come back next month with sort of recommended best practice among different funds.
Yeah, that would be great.
What's sort of cropping up a little bit is the funds each have different portfolios, so we can't come up with one size fits all. So you can't just say U.S. equity should be plus or minus, because plus or minus is a fund that doesn't have the same asset allocations as we do. So we're trying to have a group of all the consultants that put it all together and back and cycle back through. And just say, all right, this is what we should do. Something as simple as cash, we should look at it like this. Here are the ranges for each fund, and sort of bring the range discussion to an action.
Were there any additional questions?
One item on the tips.
What's that?
I'm sorry. One item on the tips. The range plus or minus 1%, I presume, is around the long-term strategic allocation. or you would have done something asymmetric. So that didn't seem to fit. And then you have a paragraph discussing that when you don't want to go into tips in the short run, the money should be placed in domestic equities. Now, I presume the choice of domestic equities, which have clearly no risk-reward relationship at all similar to tips, must have to do with, or I'm guessing, and you will fill me in, have to do with the cost of trading and things like that, because I just don't quite understand the logic.
Yeah, no, you're absolutely right. There's no correlation, or you can't make the argument that equities are a good substitute for tips in terms of risk and return. But the recommendation is really based on the starting point and where the ending point is, and the fact that tips are incredibly overvalued in our opinion right now, and trading at kind of negative, flat to negative real yields.
So you would basically be envisioning this as just more or less as you wind down domestic equities, you're just not choosing to move it to the tips because you believe it's a wrong time.
Yeah, so it's a tactical suggestion.
In which case, wouldn't you also just then make the range of allowing for like -2 or 3% up to a +1, so that you account for the fact that the tips need more money, but they're not going to get there for a while, to make it consistent with the other asset classes?
Yes, I guess we could definitely do that. We did increase the range from plus or minus 0.5% to 1, but you're right. If we have the 1 in there, which is more related to the long-term policy, then we can be out of compliance with that if we're sticking through for 4 more quarters. So we can adjust that to plus or minus 2 with the idea that it would be probably back to a plus or minus 1. We'll adjust the policy once implemented fully.
Or leave it asymmetric to wait until you get to the point. I'm not sure, but I think a consistency with your tips approach to everything else would make sense, and it doesn't appear to be the case here.
Okay. That's a good point.
And then just one more comment. Since we have an opportunistic asset class today, and we're saying we want to have either 0 or 5% maximum in opportunistic fixed income, I think we've already defined what our range is there. The upper limit of our opportunistic range is 5%, and we could have nothing at all. So let's think about whether it makes sense to have a range around an asset class that already has a range. And as well as thinking about having a rebalancing range for an illiquid asset class where it may not simply be practical to rebalance. So perhaps that's something else that you can talk over.
The thing about opportunistic fixed income, where we have this range, the plan is a range, the problem, it's a little bit like private equity. Because if you think the opportunity is there and you're at 5, let's say, you can just get a downdraft in the denominator effect, you know what you're supposed to do. Partly because it's illiquid, partly because part of that opportunistic is going to be liquid. Do we want the guy to sell when the opportunity is on? So I think a little bit similar to private equity or real estate, probably going to have some higher end rebalancing range off the target. Otherwise, you're going to be probably cutting back your opportunistic just when you want to be more. Because your denominator effect pushed you over. That's, I think, why that's why it's a range that goes over your 5. But we can talk about how we're supposed to actually implement that. Any other questions on this? All right. Great. I think that ends the public agenda, unless there's any other questions.
If there's no questions, then we need a motion to move out from the public session and move into the executive session. Oh, the camera should be off.